Hey, before we get started, I want to talk to you a little bit about our theme for this quarter, growing and protecting your portfolio. We're excited about various topics centered around this, but it really comes down to three concepts that will help you grow and protect your portfolio. You can find a PDF on our website about this. Go to wiserinvestor.com, scroll down to the bottom, enter your email address, and you'll get the PDF titled 3 Ways to Grow and Protect Your Portfolio. Thanks for listening. All right, welcome to a Wiser Retirement Podcast. We cover financial topics such as retirement planning, tax planning, portfolio management, insurance, and estate planning so you too can have a wiser retirement. I'm your host, Casey Smith, guiding you to financial freedom, or my co-hosts, Brad Lyons and Matthews Barnett. Hey, guys.
How's it going?
Hi, Casey.
So this is a special edition podcast for our Wiser clients. We do this once a quarter. Talk a little bit about market performance, some changes in our portfolios, and some changes in our technology this time.
Sure. Anything that's coming up that they should be aware of? So,
Brad?
Yes?
You're the portfolio man.
Yes,
What
I
you
am.
got?
You know, fourth quarter of 2021 really capped off a great year. I mean, if in 2022 we had the same results that we had in fourth quarter of 2021, I think we'd probably be happy, to tell you the truth. The S&P 500, probably our most well-known index and those that our clients are probably most familiar with, had a 10% gain in the quarter alone. So capped off a year at 27% with a 10% gain in the fourth quarter. I mean, that's just great. So we really got a year-end rally there. It fed well into our portfolios, given that our most heavily concentrated position is in the S&P 500 or highest conviction there. So that really drove performance for our portfolios and our clients, for this past quarter and finishing out the year.
This is a 28% rate of return from the S&P 500. That's a great
for the year.
Yeah,
that's terrific. You love it when those years come along. You can't count on them year after year,
right.
But when you're there and you're participating in it and you're invested, it just feels great. I know that when we do our planning, Matthew's here is with us. I know through his planning process, we're not planning for 28% returns. We're planning for something, much less than that. But when we get these, we get to bank those for our clients and, let that accumulate in their portfolios for future use.
Now, Brad, on the flip side, short-term bonds returned a negative 1% this year if you held it from beginning to the end. What is our take on why bonds should still be in a portfolio at this point?
We're reviewing this, daily almost relative to our client portfolios. Bonds continue to play an important role in all portfolios. They give us a more certainty of return, given that they have a stated interest rate on them. They mature at face value, so you know that you have a stated ending value to the bond at term. They mitigate the risk of investing in equities in a portfolio, and they provide some interest, some income to the portfolio as well. So we continue to be invested in bonds. We know that this is a difficult period, given that interest rates are creeping upwards through some of the actions that the Fed Reserve is taking. So we're seeing a little bit of that, and interest rates and bond prices tend to have an inverse relationship to one another. So as interest rates rise, the face value of the bonds that we're holding can go down somewhat depending upon the economic conditions. So we're seeing a little bit about that, which is why, Casey, we have an overweight to equities and an underweight to bonds in all of our portfolios right now. But bonds continue to play an important role. We're utilizing different durations in our bond portfolio to help manage and mitigate now the risk in the bond portfolio of rising interest rates. So we've shortened the overall rate of duration in the bond portfolio to be less than that of the U.S. aggregate bond index. So as interest rates rise, our portfolio should be less volatile than the aggregate bond index as a whole.
So basically, we're focused on quality bonds and shorter maturity.
That's right. All
Less
of the
risk.
bonds are investment grade or higher. So it's all investment grade, and they're all shorter term than the overall bond market itself.
And and over the last quarter, what changes have we made to our models?
Well, recognizing that inflation has really come on, it's the highest it's been in 40 years, and is likely to spend some time with us here in 2022, we decided to exit one of the bond positions in the portfolio and implement a TIPS position. TIPS is a short-term treasury inflation protected security. So it's a treasury inflation protected security with a short-term duration to it. This security is designed that as inflation goes higher, the value of the underlying position and the rate at which the investor is paid on the bond increases with inflation. So it has an offset to inflationary aspect to it. So we implemented that in order to protect against any loss in value in the bond portfolio due to rising interest rates. So we get an increase in the TIPS if in the case that we have a decrease in the rest of the positions in the bond portfolio.
So everything that we're predicting in the interest rate environment now, if that comes true, the new TIP fund would probably be kind of stay at its current value. Well, it's really protecting us if inflation's bigger than what the market has anticipated.
Yes, that's where you get the greatest rise in the underlying value of the TIPS security itself, is if inflation comes in higher than expected. Okay, now inflation is expected to be with us throughout the rest of 2022 now.
Yep.
So
before it was transitory. Thank you. It was transitory.
Yeah.
Where now we're hearing less transitory. I mean, it may be here for throughout the year, tapering near the end of the year.
Yes. Now, what the Jerome Powell at the Federal Reserve has said, now it's supply and demand implications is causing inflation. Now, what that means in classical economic terms is supply and demand, which we all learned about in Economics 101, and the way that the Federal Reserve deals with supply and demand issues is through their interest rate mechanism. So if supply and demand is out of equilibrium and there's greater demand than there is supply, which causes inflation, they can raise interest rates in order to reduce demand, so by reestablishing equilibrium in the supply and demand curve. And when you raise interest rates, you can have a negative effect on bonds. So the TIPS position, again, is in there to offset that negative effect. So we would expect it to be neutral.
And if interest rates rise, we also expect the dollar to increase in value potentially versus other currencies.
Right.
And we have
a position in international fixed income securities,
which is hedged to the U.S. dollar.
Right.
So that would benefit
just for that purpose
as well.
Right.
And quite honestly, if the dollar does increase, that supports foreign investments, which have been or should have been higher than U.S. investments, according to almost every single report that I read for like the last 10 years. And it hasn't really happened yet.
Right.
But that's the catalyst for that. Is our dollar actually be our dollar decreasing, wouldn't it? So I don't
to make the goods cheaper here.
Yeah, to make the goods cheaper here. So I don't see the catalyst for that right now at all.
No. We'll talk a little bit about this, but throughout the world, different regions had greater dispersion in their stock market returns than we had here. So in Europe, the stock market did quite well last year. In Asia, it did much less well.
Yeah.
So throughout the different regions, their economies are recovering at different rates.
We have a lot less exposure to Asia.
Right.
I remember the whole China research that we did. We have 1% exposure
overall in a portfolio.
Very small.
Yeah.
Very small. Okay, so we have a game plan for bonds in a rising interest rate environment. Our equities, we don't see any changes on that front.
No, we really don't. We see another year of rising corporate profits. In 2021, profits were at an all-time high. We see profits normalizing a little bit over in 2022, being somewhere in the 10% range, I think is what's being called for. And as such, we're looking for the stock market to do equally as well throughout next year, commensurately with corporate profits. And given the fact that this is what we had pretty much expected at this time last year, and we got extra from the stock market.
Right.
Right now, we're staying pretty well pat in our portfolio, where we are allocated between large companies and small companies in the U.S. We have a technology sleeve. We have a quality sleeve that we've talked about in previous broadcasts, and we have some exposure to real estate. Now, ironically, real estate did quite well last year. It came out had a very good fourth quarter as the economy continued to recover and people going back to work. But in real estate, one of the interesting things there is the move from the traditional office space to distribution centers and to cell towers and to warehouses that house server farms for our internet usage and so on. So,
yeah, when public REITs, the ETFs got sold off, that was throwing the baby out with the bathwater.
Yeah,
I mean, I looked at that going, you guys, I don't understand. Real estate's not. Office REITs aren't. Nobody wants them because everyone's gonna be moving out of the office. Well, first of all, they have leases. They have
to be paid.
Still have to be paid. And they're actually repurposing them. I've read many articles about stay-at-home, work-from-home companies. They're now using the old space, renovating it to be more accommodating for large events. So they're coming in once a week, but they're doing a fun event as opposed to actually working just to kind of keep some type of company.
Some culture,
yeah, yeah, and
right.
actually know what people look like. But yeah, when you look at those REITs, the top holdings are public warehouses. It's not public storage. That's where you put your old couch.
Right.
Public warehouses,
right.
where think Amazon, but
right.
for
distribution centers
for the small business owner who wants to be able to work from home, sell the product, sell the widget. The widget is imported in, sits in the warehouse, and then they move it out, right?
Right.
UPS is another one that does this, I think, very well. So I think we're starting to see people are realizing that, and that's where you saw that higher rate of return.
Right.
And there's no place to find yield, so you're getting good yield out of that sector.
Real estate, can often be thought of as a bond proxy because it does pay that generated income stream from rental income. So exactly right. And then we still have we're staying with our international allocation, where we have allocations to developed markets and to emerging markets as well. So that pretty much covers the portfolio. It's broadly diversified. It's globally diversified. It matches well with the bond side. So I don't see, a whole lot of changes coming forward in the next year, other than maybe rebalancing if need be.
Yeah, and the cost is still low. Average cost of the portfolio is still 5 basis points, or 0.005%.
Which means all that return is being imputed back to the shareholder. So
still trades for free
yeah.
on the TD Ameritrade platform. Okay, so I guess just some housekeeping things. Schwab has purchased TD Ameritrade. This happened over a year ago, and the transition is still very, very slow. So I don't expect anyone to see Schwab statements for probably another year and a half at this point. So we're going to keep, kind of status quo on TD Ameritrade and what we do with them already. The second thing is more internal, just specific to our firm. We are transitioning right now out of Morningstar. So Morningstar's, our relationship with Morningstar is they go to TD Ameritrade, they download the daily transactions that happened at TD, pricing data from TD into their software, and then we use that to report performance. You'll know it as like the Morningstar Vault. So you log into the vault, you see performance, and you have all your documents in there that we upload to you as well. Well, effective immediately, Morningstar is going off the platform. We've been working on this for 6 months. We moved to a new service called Orion. Inside the Orion platform, there's a new portal. And we have done a instructional video on how to access this portal, which will be emailed to you here in the next few days. By the time you hear this podcast, it could be that you already have it. You can self-log in or self-set up the new portal. And I'm really excited about this. We're a emerging firm. We have been for several years. Our firm grew just a little over 55% in the last year, 35% a year prior to that. I see this year easily being in the 60% range. And I have to start, as a business owner, I have to start looking ahead. And we're going to be $1 billion firm. We're going to be a multi-billion-dollar firm in a few years. So we start looking at what technology is available at these much larger firms. And Orion is always on that list. And so Orion will now replace Morningstar for client reporting. On the back end for us, it does amazing things that Morningstar was not able to do for us, which is great. Some of it is more tracking and performance research, but honestly, a lot of it has to do with just compliance. We're regulated by the SEC, and to be regulated by the SEC requires a lot of reporting once we go through their audits. And this new system makes that very automated versus the old system. So in the return, you're getting a portal which looks a little cleaner, but it kind of functions the same. And we're going to be transitioning over the next month or so. We'll be transitioning your old files that were on the old portal onto the new portal. And this is a very painful manual process that we've already begun. So that's it. You get access to this new portal. You just go to wiserinvestor.com, client access, click on Wiser Portals, the first one on the drop-down list. If you have any questions, you call our office. Tiffany, Megan, Alexa, myself, we can all walk you through any trouble that you might have on getting access. Then we got to get to the most important part of this whole presentation, which, if you guys remember, a year ago, we chose which funds or stock or index we thought would outperform for 2021. Some of us went political. Some of us went tech. Some of us went with the boring
cop
index
out
fund.
Easy index fund.
So, drum roll, please. Maybe we should revisit the picks first. Matthews went political on us. He went with the Invesco Global Clean Energy Total Return ETF.
Did great in 2020.
In 2020, yes, you're up like 145%.
Yeah.
Would have won hands down. Brad went with the S&P Kensho New Economies ETF, which I really like the theme of that.
Yeah, it's an innovation thing. Mm-hmm.
So that played out in 2020 fairly well as well. But not so much in 2021.
No, not so much in 2021. I had a very small gain in 2021. It seems that what occurred, and Matthews, you can talk to yours if you like, but innovation that was thought up in 2020 as a result of COVID for many instances worked its way fairly quickly into the general economy, into industry itself. And so the innovation was spread out into the general economy and was less focused in innovation in and of itself, for 2021. So we didn't see the returns in there, but we saw it in other industry sectors where companies had utilized new innovation to become more efficient and more productive in the face of a changing work environment and a changing economy. So, innovation is still out there. It's still something that we need to have in our economy. And I think going into 2022, those companies that can innovate and utilize innovation are going to do better than the rest because it'll make them less dependent upon, well, let's face it, it'll make it less dependent upon, their workforce.
Yeah,
the manpower.
In certain industries,
okay?
Yeah, for sure.
It'll help offset, if you can increase productivity and at the same price, you're effectively offsetting inflation. So the only way a company can offset the rising costs of their expenses is to increase productivity. So if they can implement innovation in order to do that, they can offset the rising costs. So I think those companies that can innovate and utilize innovation will do well again in 2022. But we'll see that in the general economy, not necessarily in innovation itself.
Yeah. And I think your pick, Matthews, is more based off of, Biden coming into
some clean energy initiatives that were supposed to happen. It didn't really reflect in the fund or the market so much yet. But it's kind of funny that one of the best sectors of the year was energy. So it kind of flip-flopped on us
right.
there. Clean energy wasn't, but the energy sector overall did pretty well. So one of those reasons you just never know. Things, the market's cyclical. One year, the best performing asset class or sector could be the worst the following year.
And I chose, you guys call it boring. I think Matthew said cop out, whatever that means. But I always went with a total market because my whole thing is like, I'm terrible. I'm the worst guy to take to Vegas. I'm not so good on the short-term stuff, but I think long-term, always win by owning the averages. Now, we have lots of podcasts that support all this, and you guys had more fun with it. So you definitely got more joy out of the process, maybe.
Well, there was a lot of cajoling throughout the year because we all knew what our picks were,
But yeah, so Clean Energy Fund down 22% last year. The Brad's New Economies ETF pick up 3.69%. And the total U.S. stock market was up 25.67.
There you go. We have a winner.
Wins again.
Yes. So yeah, I'm not going to gloat. It's all right.
Well, the other picks that we had was the overall markets themselves. We picked on what we thought the S&P would be. We thought what the Dow was going to be.
Do you have this documented?
I certainly do.
What did we say? We
said the S&P would hit 4,500.
Okay.
And it ended at 4,776 or something like that.
All right.
And we said the Dow would hit 35,000.
Huh.
Okay. So we were right on both of our picks, and that plays well into your pick for the total stock market being
true,
having done so well. So
true.
Yeah.
Okay.
Good job, everyone.
This year, 2022.
So are we going to lay out?
You sound like a Cub fan.
Yeah.
Wait until next year.
It used to be Atlanta, but that was a good year last year.
Yeah.
So are we throwing out picks now?
Well, I think we should. I think we should be, set ourselves up again.
Huh. All right. I don't know if I'm ready for this.
Well, you have some time. Why don't we start with the S&P 500? It's currently ended the year at 47.76, and I had mentioned a little bit earlier in this podcast that corporate profits are expected to rise about 10%. And if corporate profits are what really drives stock prices and valuations, and valuations are a little high, but they seem to be supported in the marketplace. So I'm going to pick, S&P ending the year at 52.5, which is about a 10% increase.
Okay.
I'll go even 5 flat.
5%
at 500 or 5,000.
Oh, 5,000.
Yeah.
I'll go. I think in single digits for 2022. We need to cool off a little bit. I think there's probably some political things out there we don't quite know or understand about. I mean, we weren't able to get a full deal, right, on anything.
Nothing yet.
So I think there's might be some surprises sitting out there, but we need a normal year. We can't keep going at this pace. Now, on the counter of that, wages are up. Wages, people are making more money, more people are employed. So you have more people able to spend money. You've got the government trying to run a stimulus plan, which it's just adding kerosene to a well-lit fire already. So I guess if inflation, well, you know what? If inflation goes through the roof, because people are making more money, and we need to have a supply chain because of COVID, I guess, then I can see a 10% increase. I can see a 10% year.
Mm-hmm. I think it's very possible.
There's some things.
Now, that's not to say that there won't be some bumps throughout the year, as you were alluding to. In 2021, the S&P did not have a correction. The lowest it went down, I think it was like 5%, a little over 5%.
All right.
So I know that the NASDAQ had a correction. Small caps had a correction, but the S&P didn't. So it wouldn't surprise me if we didn't have it would surprise me if we did not have a correction at some point in time in 2022.
Well, we need healthy 5-10% pullbacks. 10% that would take a big catalyst for that, I think, at this point. But just a normal, good old sell-off at 5% keeps people honest. Mm-hmm. We need that. It's healthy. So I'll go 3,100 on the S&P.
51?
30, or what's it at now? 27?
47?
Oh, 47.50.
Yeah.
Sorry, I did my math wrong. Yeah, so 47.50. I want to round up though. 5,300. It's a little greater than 10%.
Yep. Okay.
So we got 3 different predictions there. I do that.
And I'm saying about 40,000 on the Dow.
Yeah, whatever that 10% is on the Dow.
Yeah, it's about the same now. The prognosticators are thinking value over growth. There's probably a little more value in on the Dow. So, but I'm not going to kind of go with that. I'm going to just go with if we hit, I think 40,000 is a milestone in the Dow, and not just because it's higher than it is now, but rather it's a psychological milestone that from there, I mean, who knows what could happen at that point in time. So if we hit 40,000, we will go through a psychological bear on the Dow. And I'm suggesting that we might this year.
Okay. Well, so let's shift that to individual investment picks. You said S&P 500.
Yeah, I'll go plain vanilla and just say S&P 500.
You're going to get his 10% and go home.
Yeah, call it a day.
I think Matthews is always a year late, so I'm gonna
reverse it.
I'm gonna go out on a limb. This is not a big limb because I'm not a huge risk taker, but inside our portfolios we use VGT. They had a good year this last year. It's up 35%. I'm going to bank that, they're reclassifying companies so to get tech companies out of tech into other sectors.
Right. That's expected to go through somewhere at the end of the first quarter or thereabouts.
So I think that changes the face of VGT a little bit, and it probably brings in real tech into VGT. So I don't know if it changes the cap size necessarily, but I could see newer refreshed companies rising up. They're probably already in the fund. They're just very small percentages. I can see those rising up, right?
Right.
And as fast as we're creating new things, and as fast as we need software companies to do that, because that's what really VGT is a lot of software companies, right? I would be willing to come off of my VTI and say that technology inside VGT, it's a little different technology, right? Inside VGT probably outperforms the average still for 2022.
Yeah, that's a good pick.
It's not a crazy pick, but it's a safe one.
Yeah,
it's a safe one.
Yeah, I'm going to go with real estate.
That's my second choice.
Yeah, I'm going to go with real estate. When we started out the year last year, I wasn't
publicly traded REITs, not rental homes.
That's right.
Okay.
Yeah. Not private equity.
Brad needs a week off. He's rehabbing.
We're talking about my house.
Right.
I'm hoping my house has a great year. But for the reasons that we talked about earlier in this podcast, that how we're utilizing real estate a little bit differently in currently and going forward than we did in the past. And I think there's tremendous upside in these distribution centers and these server farms and cell towers that they should really do well going forward. And I'm expecting real estate to have not just another good year, but in fact a year that surpasses the overall stock market.
All right, so we got it. S&P is a choice. That's always a good choice. Just not when you choose VGT or real estate.
Hopefully I didn't jinx it there this year.
And that's true. I didn't think about that. There's a lot of weight in your shoulders right now.
I'll take it.
And then we have real estate. Which fund? Because there's different real estate funds.
Well, we're utilizing the iShares product, which is a global product, REET. And this global diversification will allow for these areas throughout the rest of the world to participate in this change in real estate. So I'm going to go with the REET, the one that we have in our portfolio. I think it's a good pick. All
right, REET. Mine's VGT. It's a Vanguard Technology Fund. And are you going to go with VOO, IVV, or SPY?
Let's go SPY. Switch it up.
All right.
SPY? Why would you choose that one that doesn't reinvest its dividends?
I don't know. Switch it so we don't have all our portfolios in there.
Put him in IVV. Don't write down SPY. Nobody uses SPY. It is the largest ETF. That was yeah. They use it as a holding point though.
It's a benchmark.
They're holding it temporarily. Come on, guys. SPY is a trust, right? And the dividends they get paid out go to cash and don't get reinvested into the fund. They stay in cash until the dividend date, then it pays out. So if the market is going to go up, IVV is going to have a higher rate of return, only by a nickel, but still, IVV will have a higher rate of return because it's reinvesting its dividends back into itself until it has to pay out to clients, right? So, okay.
So that's it.
Yeah.
Right.
Yeah.
Am I the only nerd here that knows this?
Just make it clean and simple for everybody out there.
No, that's how ETFs outperform.
Yeah.
Is through their cash management activities.
Right.
Which a dividend is a cash management activity.
So on the way down,
Yeah.
I want an SPY. On the way up, I want an IVV. Yeah. Everybody knows this. All right. All right. Good conversation.
All right.
Thank you.
Thank you.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening, that way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore. Wiser Wealth Management Incorporated is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and unless otherwise stated are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.